Welcome to The Explainer, where we break down today's biggest market moves. We're going to unpack the huge surge we're seeing in global markets and tackle the big question. Is this just another bubble, or is the AI revolution finally starting to pay off? Okay, let's dive right in. Global markets just hit new highs. So, is this a bubble, or is there something more fundamental going on here? The answer, it isn't just about hype anymore. It's about a massive shift happening right now with artificial intelligence. The whole conversation has moved on from potential and landed squarely on profit. So let's kick things off in the U.S. Today, February 18th, 2026, the major indices really pushed higher. And the story behind these numbers? It's all about the AI payoff.
I mean, you can see it right here. The gains were clearly led by tech. Take a look at the NASDAQ 100, up a solid 0.80%. And the Philadelphia Semiconductor Index, what we call the SOX, climbed almost a full percent. At the same time, you've got the Dow just knocking on the door of that massive 50,000 milestone.
And this right here really gets to the heart of what's happening. The market has moved past the hype. The new mantra is, show me the ROI. Investors aren't just betting on promises anymore. They are rewarding companies that are proving it with real-world results. The question isn't, what could AI do anymore? It's, what profits are you generating right now?
This isn't just some random market mood swing. It actually lines up perfectly with a theory from economist Gunter Dück. His idea is pretty straightforward. In a super complex economy, value shifts away from pure speculation and towards proven efficiency gains. And what's delivering that right now? AI. It's creating measurable cost savings and expanding margins. It's the real deal.
And if you want proof, look no further. This chart says it all. The data shows that companies who are actually adopting AI are seeing their profit forecasts revised upwards at twice the rate of companies that aren't. That is a massive performance gap you just can't ignore, and it tells you exactly where the smart money is heading.
Now, of course, AI isn't the only thing driving the market. There are a few other things helping out. Think of them as tailwinds, right? First, we've got stable interest rates. That lowers what's called time preference, which basically encourages long-term investment in big firms like Amazon. Plus, strong fundamentals are helping the market overcome that classic wall of worry, even during what's usually a weak season. And to top it off, the VIX, the fear index, fell over 4%, which signals that investor confidence is definitely on the rise.
Okay, let's jump across the pond to Europe, because the story there is actually a little different and in some ways even stronger. The momentum was incredible today, hitting new record highs across the board. And what's really interesting here is just how broad this strength is. I mean, look at this. The FTSE 100 in the UK, the CAC 40 in France, the DAX in Germany, all up. The Eurostoxx 50 climbed a really remarkable 1.35%. This isn't just a tech spillover. This is a sign of a much wider, more fundamental recovery happening in Europe. So what's fueling this momentum in Europe? Well, it's really a combination of things. You've got UK inflation cooling down to 3.0%, which has everyone hoping the Bank of England might cut rates soon. You've also got just plain old corporate strength. BAE Systems reporting 12% profit growth, Glencore announcing a massive $2 billion buyback, and a little bit of political stability helps too, like France finally getting its budget approved. Oh, and of course, there's that U.S. tech spillover, with companies like ASML and Siemens riding the global AI wave.
Okay, so that's what happened today. But what about tomorrow? What does the forecast look like for the next month, given all this action?
Well, we're looking at a forecast based on over 100,000 simulations, and the picture it's painting is pretty positive. The models are pointing to continued upward momentum across basically all global markets. It looks like this rally might have more room to run.
And the models are especially bullish on one area in particular, semiconductors. We're talking a projected gain of over 8%, 8.3% to be exact, for the Philadelphia Semiconductor Index. Why? Well, it's that insatiable, nonstop demand for the next generation of AI chips. The outlook is also looking really strong over in Asia. The forecasts are showing significant gains, especially in places like Korea, where the Kosdaq is projected to jump a whopping 10.3% thanks to some new reform momentum. And over in China, the SEE Composite could see a nice 6.6% gain as everyone expects some new stimulus to kick in.
So with all this going on, you might be asking, how do you even navigate this? Well, the report we're looking at outlines a specific quantitative strategy, and we're going to simplify it for you. It's designed to adapt to exactly these kinds of changing market conditions.
Okay, so here's how this two-mode strategy works. It's actually a pretty simple two-step process. Step 1, you detect the market regime. Basically, you use a model to figure out if we're in a stable, calm period or a volatile, choppy one. And then step 2, you shift your asset mix. You adjust your portfolio's allocation based on what that model tells you. It's all about reacting, not just predicting.
And here's what that looks like in practice. In a stable, low volatility environment, the strategy leans in. It goes aggressive. We're talking about 70% in things like the semiconductor index and KOSPI futures, with the rest in growth assets like the Nasdaq and Amazon. But the moment things get volatile, it flips. It pivots hard to defense. 60% goes into defensive assets like gold and T-bills, and the other 40% goes into hedges like the U.S. dollar index or VIX call options.
All right, let's pull back for a second and bring it all together. After digging through all of this data, what are the crucial takeaways? What should you really be focused on?
So here's the bottom line. For the US, this rally is being driven by real AI profits, not just hype. That's key. For Europe, it's a solid recovery story, fueled by falling inflation and strong corporate moves. And for Asia, Korea's market reforms are a huge catalyst for growth. When you put it all together, this really does look more like a brand new value creation cycle and less like a speculative bubble.
But there are always risks, right? And the primary risks on the horizon are two big ones. First, the FOMC interest rate decision coming up on March 18th. That's a huge one. And second, any potential changes to international trade policy. Either of those could definitely throw a wrench in the works.
Which kind of leaves us with this final question. All the data points to a new era of tech-driven growth. The engine is there. But with these new policy decisions on the horizon, will that wall of worry prove to be too high to climb? That's what we'll be watching.